Developing a simple trading plan. Introduction. Welcome to Developing a Simple Trading Plan. A trading plan is essential for success, acting as a roadmap that guides your decisions and keeps your emotions in check. Without a plan, trading can quickly become impulsive and inconsistent. Today, we'll cover the key components of a trading plan and how to refine it over time. By the end of this session, you'll have a blueprint to start building a structured and disciplined trading strategy. Section 1. Why you need a trading plan. Purpose of a trading plan. A trading plan removes emotional decision-making and enforces discipline. It sets clear entry and exit rules, risk management, and overall trading goals. Example: instead of guessing when to exit, your plan specifies profit targets and stop-loss levels. Consistency over randomness. A structured plan ensures consistent decision-making across all trades. Example: if you follow a strategy with a 60% win rate, applying it consistently ensures long-term profitability. Accountability and learning. By following a plan, you can analyze what works and what doesn't, leading to improvements over time. Section 2. Components of a simple trading plan. Define your trading goals. Set realistic and measurable goals. Example: earn 5% monthly growth or risk no more than 2% per trade. Identify your trading style. Choose a style that fits your schedule and personality. Day trading, multiple trades in a day. Swing trading, holding trades for days or weeks. Position trading, long-term investments. Select markets and instruments. Focus on stocks, Forex, crypto, or commodities, depending on your interests and knowledge. Example: trade Forex pairs like EUR USD or focus on tech stocks. Develop entry and exit rules. Entry signals. Use technical indicators like moving averages, RSI or MACD, or fundamental events. Exit rules. Predefine profit targets and stop-loss levels. Example: enter when price crosses the 50-day moving average, exit when RSI reaches 70. Risk management. Never risk more than 1 to 2% of your account per trade. Use stop-loss orders to protect capital. Ensure each trade follows a 1-2 risk-reward ratio. Section 3. Building the plan. Step by step. Set up a demo account. Use a demo account to practice your plan without real money. Example: if testing a swing trading plan, hold trades for several days and track performance. Backtest the strategy. Review historical data to see how your plan would have performed in the past. Example: apply the strategy to the last 6 months of EUR USD price data. Track and adjust. Maintain a trading journal to log every trade. Entry and exit points. Profit and loss notes on what worked or didn't. Example: if multiple trades hit stop-loss too quickly, adjust your entry point or stop-loss distance. Section 4. Refining your trading plan. Review and adapt. Markets evolve, and so should your trading plan. Schedule monthly or quarterly reviews to evaluate performance and adjust. Example: if a moving average crossover strategy works in trending markets but fails in ranges, adjust your indicators. Focus on continuous improvement. Refine stop-loss placement and experiment with new indicators or timeframes. Adjust risk tolerance based on your experience and account growth. Conclusion: a well-structured trading plan is your path to consistency and profitability. It reduces emotional decision-making and provides a framework for long-term growth. Your next step: draft a simple trading plan today. Test it in a demo account for the next 30 days. Refine it based on results and build the habit of following it with discipline. With time, you'll develop a plan that aligns with your goals and trading style, setting you on the path to trading success.